This video will help you understand how to apply tax bracket management so you can minimize the impact of taxes on your retirement income. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. During the accumulation phase of one's wealth, real estate, investment accounts, etc., there's not a tremendous amount of control one has over their income tax liability. Now, if you're self-employed, you have a bit more control than salaried W-2 folks. But the script is flipped when you enter into retirement, because in retirement, you have a lot more control over which investment accounts and which resources you're going to draw on for retirement income. So in today's video, we'll cover how you can control certain buckets to minimize the impact of taxes on your retirement income, which ultimately just increases the certainty that you won't run out of money. So let's jump in. In my last video, which I'll link above here, we touched on the basics of understanding tax bracket management. We touched on how federal income taxes work. We touched on the most popular sources of income that retirees have access to, those accounts, pre-tax retirement accounts, Roth accounts, Social Security, non-qualified or like brokerage type accounts. And then we touched on the flexibility one has over choosing to take distributions from said account or choosing not to take certain distributions if you don't have to. We added all that up together to understand how one could effectively minimize taxes in retirement. So now let's use what we've learned and apply it to some real world scenarios. Let's take an example couple that needs 10 grand a month net after taxes to meet all of their lifestyle needs in retirement. And I'm gonna refer to net of taxes a lot in this video because that's how people think. And if you are going to DIY your own financial planning, odds are that's what you're thinking too. And you'll have to reverse engineer taxes. Of course, if you're an advisor and you're learning how to tax bracket manage through watching this video, in my professional opinion, you'll also want to translate a lot of these numbers into the net amount that lands in a client's bank account, because ultimately that's what they're thinking they can use and spend and enjoy retirement with. So for this example couple, they need 10 grand a month net after taxes to meet all their lifestyle needs. Times 12 is 120 grand. So we need to find $120,000 a year net of taxes for this couple to successfully retire. In this first example, we're going to assume no Social Security exists, which is not the greatest of financial planning assumptions unless you want to be like super duper conservative. But just to understand the various buckets and how they apply, we're going to forget about Social Security just for this first example. The super simple math is if a client needs 120 grand a year net, you want to divide that number by about 5%, and that'll give you the amount of money that the client would probably at least want to have in investment resources. So for this example couple, 120 grand a year divided by 5% is about $2.4 million. Now, is the 5% rule the greatest of all retirement planning assumptions out there? No, there's more nuance to be had. You could be a little bit more liberal and assume that the client is going to adjust their spending given market conditions using a 5.6% distribution rate to start with. And that refers to the Guyton Klinger retirement income research, which I'll link down below. You could also use other retirement methods of drawing income out of, but just to keep it very simple for the math, we're going to assume a 5% distribution rate every year, which reverse engineers to 2.4 million. Let's say of the 2.4 million, 2 million is in a pre-tax traditional IRA and 400 grand is inside of a Roth IRA. Now, most financial planning software would have the client default to liquidating all of their traditional IRA before ever touching the money inside of the Roth IRA, the more tax efficient bucket. In reality, is that a great planning assumption? In my opinion, no, hence the purpose of this video. But as a general planning or back of the napkin math assessment tool, it's not the worst assumption in the world. It's also a really, really good strategy if your goal is to overpay in taxes. And we'll talk about why that is. Let's say dogmatically we follow the off-the-shelf financial planning software's recommendation and we fully meet all of the 120 grand net income needs through only using our traditional IRA to start. For this example couple, if they were to use your off-the-shelf financial planning software and liquidate their traditional IRA first, they would actually need to pull out a gross distribution of about $133,000 to net $120,000 after taxes. And this results in about $13,000 in total tax liability. Let's walk through how I did that math. So the first $30,000 or so that's pulled from a traditional IRA or that's earned an income or whatever, one could kind of think of as tax-free because of the $30,000 standard deduction for the tax year of 2025. And the standard deduction kind of goes up with inflation, so if you're watching this in a future video, the numbers are going to be kind of similar. The standard deduction, every taxpayer is entitled to if they have at least that much income. So for example, the first 30 grand pulled from this client's traditional IRA, you could consider tax-free. So now, instead of solving for 120 grand net, we actually only need to really solve for about 90,000 after taxes. If you pull $103,000 out of a traditional IRA, you'll net $90,000 after taxes for this example couple. And to get to that nuanced math, we'll pull up those 2025 married filing jointly tax schedule. The first 30 grand pulled from a traditional IRA, we're going to consider tax-free given the standard deduction. The next $24,000 pulled from that traditional IRA is going to be taxed at about 10%, which is a tax liability of $2,400. The next $75,000 is going to be taxed at 12%. And that results in a tax bill of $8,800. And the last $6,050 that the client would need to pull out to meet their income needs would be taxed at 22%. Federal taxes are done on a marginal basis, which means certain bands of income are taxed at different rates. Also, this is called being taxed at the margin. The last $6,050 taxed at 22% results in a tax liability of $1,300. The total tax bill for this client would be $12,500. And if you're doing this math at home, the technical answer I think is $12,488. But we're just going to round and say $12,500. Now, is $12,500 in tax liability the worst thing in the world? Not necessarily, but had this client actually employed tax bracket management, the client would have shaved off their tax liability around $2,000. The way they would do this is they would first pull 120 grand out of their traditional IRA. Remember, the first 30 grand you could consider tax-free given the standard deduction, and the remaining 90,000 is only taxed at those first two rates. Going back to the tax schedule, if we look at where 90,000 bucks of taxable income lands, it all falls into those first two tax brackets, 10% and 12%. And in fact, we don't even fully fill up that second tax bracket. The first 24 grand, once again, is taxed at 10%, which is a resulting tax bill of around $2,400. But to fill up 90 grand of taxable income pulled from the traditional IRA, that only fills up the second bracket by about $66,000. 66 grand taxed at a 12% rate results in a tax bill of about $8,000. The remainder of this client's income needs, they should pull from their Roth IRA, because then they completely avoid being taxed at that 22% rate. Total tax for this client would be $10,400, which is basically $2 grand short of what they were otherwise going to pay had they pulled all of their income from the traditional IRA. Through tax bracket management, we keep the client in the lowest possible tax brackets and ideally avoid as much as possible of money being withdrawn and taxed at those highest margins. Now, that's all going to be relative to whatever the income needs of that particular client is. It might be totally unavoidable that you fall into those brackets. But for this client, their highest bracket is 22%, and we can avoid that without over-distributing from their Roth IRA by dipping into their Roth IRA before falling into that third bracket. Now, I know what you might be thinking. Well, why don't we just pull more out of the Roth IRA to avoid taxes altogether? And you could totally do that. However, you have to be careful not to violate the 5% rule, if that's what you're going to stick with, in the Roth IRA. For example, if you pulled all 120 grand that they need from the Roth IRA only, well, you're going to be out of Roth IRA money within a couple of years. Now, you could make the argument that, oh, they've got a little bit more room to grow inside that 12% bracket before they have to dip into the Roth IRA. And that is true. I'm trying to use easy round numbers. There's always more nuance to be had if you're going to right size in the perfect way how to tax bracket manage away from paying taxes at the highest margin. Where all this math comes back in spades to you is ultimately resulting in less tax liability to the government, which means more income and more resources in your pocket. And mathematically, we can show this because in the non-tax bracket managed example, where all of the client's income needs are being pulled from the traditional IRA, that results in about 133 grand leaving their investment accounts, which reverse engineered is a 5.5% distribution rate. Whereas in the tax bracket managed example, it actually only results in 5.4% distribution rate on their assets. And they paid less in taxes, and that's exactly why. Now, you could say, okay, Chris, 10 basis points or 0.10%. Is that really going to move the needle over a 20, 30-year retirement? Well, maybe, maybe not. But as you can see, as these numbers get bigger, the impact of tax bracket management absolutely exponentially increases. For example, and we won't walk through all this math, if the client needed 20 or 30 grand a month, well then they save that much more in taxes as a result of tax bracket management. Okay, let's take that same example couple that needs 10 grand a month to pay all their bills. Instead though, this time, let's throw in some Social Security. Let's say each spouse earns 2 grand a month from the Social Security Administration, which is not exactly ever what would really be the case. Most likely they'd be different numbers, but just to keep it super simple, let's say 2 grand a month comes from the first spouse and 2 grand a month comes from the other spouse. Before we jump into the math, know that with Social Security income in retirement, Social Security income is not always tax-free, nor is it always income taxable. The amount of your Social Security income that's considered taxable income, and then you ultimately pay taxes on that income, is dictated based on how much money you earn in income from other sources. And this calculation is called provisional income. I'll link above here to an explainer video on how to do this math for your particular situation. But the super simple understanding is the more income you have from other resources other than Social Security will increase the amount of your Social Security income that's considered taxable income. It's a common, marketing pitch out there, which maybe nefariously put, maybe not so much, is that 85% of your Social Security benefits will be taxable in retirement. And that is kind of true, kind of not true. It is possible that if you show a high enough income in retirement, that up to 85% of your benefits will be considered income taxable that you'll have to then go pay taxes on. But most people don't have 85% of their benefits considered taxable income. And definitely 85% of your Social Security check is not the tax that you have to send back to the IRS. The technical calculation for provisional income is half of your Social Security benefits plus your adjusted gross income equals a certain amount of money called your provisional income. That provisional income is then thrown onto the Social Security Administration's provisional income brackets to ultimately figure out how much of your benefits are going to be considered income taxable. And roughly speaking, if your provisional income is less than 32 grand as a couple, then none of your Social Security benefits are going to be income taxable. Whereas the money you make above 44 grand of provisional income, that's when you start creeping into that 85% includable territory. To keep it super simple for today's purposes in this example, let's assume 85% of this client's Social Security checks are considered income taxable. That means on the flip side, 15% of those Social Security checks are considered tax-free. So specifically for this couple, 4 grand a month, 48 grand a year of Social Security benefits, $7,200 is tax-free, and $40,800 is considered income taxable. Let's go back to the example. 120 grand net is needed for this couple. Remember though, the first 30 grand of income is standard deducted away. So again, we're solving for 90 grand net. Let's go back to that same example couple that needs 120 grand net, because again, that's how people think. Well, we just talked about $7,200 of that 120 is going to be tax-free from Social Security. So now we just need to solve for $112,800 net of taxes. There's a few options we could take with this client to meet their income needs. We could pull all the 112 grand that's needed from a pre-tax retirement source, like a traditional IRA. We could pull all the $112,800 that they need from a Roth IRA or some other tax-free income source. Or we could find the happy medium between the two, hence the genesis of this video, so that the client doesn't run out of money in either one of those buckets and they minimize taxes. Let's start with scenario one, where they meet all their income needs from the traditional IRA. To keep it simple, the gross distribution from the traditional IRA would be $83,000 to then pay enough taxes to generate 120 grand net to the client. Remember that $30,000 standard deduction. Well, to keep it simple, the first 30 grand of the Social Security check, only the taxable portion, which was $40,800. 30 grand of the taxable portion of their Social Security benefits would be considered tax-free because of the standard deduction. And so without getting too complicated with the math, that 48 grand of Social Security total benefits, 85% taxable, plus an $83,000 gross distribution from a traditional IRA results in a tax liability of about $10,800. So those two distributions, Social Security plus traditional IRA, minus taxes, nets 120 grand. And this results in a 4.15% distribution rate from said traditional IRA, which is very sustainable. On the flip side, what if they pulled all their income needs from the Roth IRA? Well, the gross amount they'd have to distribute from the Roth IRA would be $72,000. And the taxes are actually quite more favorable in the Roth IRA, not solely from what otherwise would have been a traditional IRA distribution, but also on the Social Security. Remember earlier when I talked about provisional income, if the client has less than $32,000 or so as a married couple in provisional income, then all their Social Security benefits are considered tax-free. Well, distributions from a Roth IRA do not count as taxable income. So according to the IRS, even if you took $1 million out of your Roth IRA, you have no income as a retiree, which also means you have a super duper low provisional income. And for this example client, all 48 grand of their Social Security benefits would be considered tax-free. And of course, the $72,000 Roth IRA distribution is also considered tax-free. Therefore, 100% tax-free Social Security, 100% tax-free Roth IRA results in no taxes owed. The downside is pulling all the discretionary money they need from the Roth IRA results in an 18% Roth IRA distribution, which is not sustainable at all. In addition, this client didn't really get to use their standard deduction of 30 grand because they had no income to standard deduct away. The standard deduction is use it or lose it. So they don't get to bank it for next year and standard deduct 60 grand. That's a one-time usage. And you can't standard deduct your way into a negative income and get like a $30,000, refund. So what's the right solution for this client? Scenario 1, 2, or perhaps a happy medium? Well, obviously I'm gonna push for a happy medium here where the client pays some level of income taxes, more than the Roth IRA example, but less than the traditional IRA example. For this example couple, I'd recommend at least pulling out enough from the traditional IRA to warrant standard deducting away 30 grand of it. Now, the downside with doing this, though, is it does cause more of one's Social Security check in this example to be dragged back into taxable income. But in my opinion, it's not sustainable to pay nothing in taxes on one's Social Security income for this couple because they're going to distribute from the Roth IRA way too fast and run out of Roth IRA money in like 5 years. So this client should get used to paying some level of income tax on their Social Security income. Then we should see what brackets can we fill up for sure every year for the rest of their life, and which brackets can we try to avoid. Well, even in the traditional IRA only scenario, given their Social Security income, they don't actually even fill up all the 12% bracket, which is that second bracket. So there's no 22% tax bracket we have to try to avoid for this couple. Now, of course, if their income needs were much higher, there'd be some play in the joints to figure out what the right amount of distribution is to pay taxes at the 10 and 12% bracket, but avoid the 22, 24, etc. So as you can imagine, the higher the income needs in retirement, maybe the smaller Social Security benefits or the more resources they have available to them, the more valuable tax bracket management will be for this client to tax bracket manage away income taxes at those higher margins. So for this example client, if they need 120 grand net, 48,000 or so is coming from Social Security, and then they would need another 72,000 or so after taxes from either traditional Roth or a combination of the two. Maybe they look at pulling 60 grand from the traditional IRA and then 12 grand or so from the Roth IRA. That results in like a 3% distribution rate on the 2.4 million of total investable assets this client has, which is super duper sustainable. It takes a larger chunk out of the traditional IRA and a smaller chunk out of the Roth IRA, both in kind of sustainable quantities for this client's retirement longevity. But of course, there'd be some more fine tuning to do to figure out the exact proportions. And it's not a perfect science because there's a lot of other factors to consider, but the best laid plans at least have a chance to get executed. Philosophically, I'm a huge fan of committing to the following flexible edicts. Number one, don't pull out more than 5% of one's total investment assets from either of the buckets unless you have a really good reason to do so. And we'll talk about those reasons in a little bit. Fill up the lower tax brackets with taxable income and avoid the higher tax brackets with tax-free income if you can. And use your standard deduction. But of course, there's some things to consider that might cause one to violate those edicts or kind of play in the joints. First and foremost would be factoring in expected changes one will need to their income or lifestyle. If we're going to be entering into a season where maybe before we file for Social Security, but we are currently retired, well, we're going to have lots of investment income needs, so we might be violating those 5% distribution rates in between, we'll say age 55 and 65, for example. There might be a decade or so where you're pulling out more than about 5%. But that's because if you do the math, once you hit 65, if just for example, you file for Social Security then, and maybe because at that point, 65, for example, a good amount of your income needs will be met through Social Security income, and you don't have to pull as much out of your investment assets. So maybe it's okay to pull out more in the early years if you're going to pull out less in the later years. In addition, for those decade or so where you don't have an income, you don't have forced income from Social Security, that might be a great time to pull more out of a pre-tax bucket and save the Roth bucket for later. In addition, if you forecast when you're doing your math that required minimum distributions in your mid-70s are going to be a problem, well, then it might make sense to voluntarily pay taxes today, between 55 and 65, for example, at a lower tax rate so that your future RMD impact is lowered. And there's probably some tax arbitrage or tax savings to be had by voluntarily paying taxes at a lower rate today rather than a potentially higher bracket in the future or whatever brackets turn into at that point. In addition, if we know we're going to have a massive purchase in a few years, maybe you're buying that $200,000-300,000 boat in 3 years, well, that's probably going to be a higher tax year. So maybe we bank our Roth money for that year because it's spending out of the norm. Or if we know we're going to sell the family home and it's appreciated $1 million, I don't know, whatever it is. Well, that's a pretty big capital gain hit. Maybe we seek to have all of our Roth money pay our bills at that point because that capital gain impact, you'll have less of it taxed at that 20% rate. And of course, there's the concern of maybe moving states. Does it make more or less sense to pay taxes today before we move to that other state that does have a state income tax, or we move from a state with a state income tax to a state without a state income tax? And there's other concerns we don't have time to get into, like income-related monthly adjustment amount, which I'll link above here, basically, Medicare surcharges if you make too much money in retirement. So from a calls to action standpoint, I'd highly recommend critically thinking through what resources you have in retirement that you can draw on, and then start thinking through a proactive strategy of minimizing taxes. One of the strategies could be through employing tax bracket management. Generally, planning by default is not the recommended course of action. Not only is it kind of a losing strategy if you're not long-term thinking through your retirement, but it's unfortunately a great way to overpay the IRS. So I'd highly recommend critically thinking through what resources you're going to pull on in retirement and then come up with a strategy to keep taxes low. Hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch with the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.